Hi, and welcome to this week's market presentation. Latest news. Starting with the latest news, we begin with Iran, where the ceasefire between the US and Iran has so far held, even as tensions between both countries remain very high. Transit through the Strait of Hormuz remains still practically blocked, with very few vessels attempting to transit the strait. The US continues to enforce its blockade of ships leaving and going to Iranian ports, with several vessels trying to outrun the blockade, having been forced back at times with direct fire from US Navy vessels. US-Iran negotiations are set to continue in Islamabad, while they are very much taking place against a backdrop of active maritime confrontation and high tensions between both countries. As transit through the strait remains very limited, with most of the Gulf's crude oil and LNG export availability halted for the time being. Energy markets continue to react very quickly and noticeably to each new development, with pricing increasing and decreasing as optimism ebbs and flows. Nonetheless, both crude oil and global natural gas prices remained lower than at the peak prices of the month ahead for both Brent, with prices now below the $100 per barrel price level, and natural gas prices in Europe at around €40 a megawatt hour versus 61 at its peak. Markets remain very volatile due to headline risk, and we are now seeing profit-taking driving markets as well. Beyond the war in Iran, with a focus on the European Union, the European Commission is preparing discussions on a temporary crisis framework to let member states support their respective economies hit by the Middle East energy shock. The goal of the framework is to cushion higher gas, power, fuel, and financing costs without letting such a response turn into a permanent subsidy regime. The logic is to protect EU industry and the European economy, especially energy-intensive sectors, while keeping the aid very much targeted and temporary. For energy markets, the main effects is to limit demand destruction and soften the economic damage, but very importantly, will not have an impact on increasing the actual total supply. Markets' reaction remains limited, as few details as to how the framework will work in practice has yet been released. Nonetheless, if adopted, the framework could help keep industrial gas and power demand firmer than it otherwise would be. This could in turn exacerbate the supply shock that the war in Iran is having on the market. While it may reduce the risk of abrupt plant shutdowns or deeper output cuts in energy-intensive sectors and will overall help the overall economy, it could bring increasing import prices for fuel and natural gas in particular. Weather. Beyond the latest news, the latest weather forecasts indicate generally above average temperatures across Europe, with mild weather forecasted over the next 7 to 10 days. Precipitation is forecasted to remain limited, especially in the Nordic region, which will continue to add pressure given the negative hydrological balance in the region. Looking at wind speeds, following a week of quite disappointing wind output due to average wind speeds, we are now forecasting a slight increase in wind speeds throughout this week, which will lend a boost to overall wind power generation. Macroeconomics. Towards the latest macroeconomic indicators, we see the global PMI figures for the services sector having been released, showing a slight decrease over the month of March, likely tied to the economic impacts that the start of the war in Iran has had on the global economy. Looking at the core inflation rate, we see core inflation for the euro area remaining relatively steady, while the overall inflation rate increased sharply over the course of March, very much indicating the fact that the rise in inflation very directly impacted by the increasing fuel cost due to the war in Iran. Crude oil and LPG. Looking towards crude oil markets, crude oil prices have seen a further decrease over the past week as optimism regarding first a resumption of transit through the Strait of Hormuz and a more lasting peace agreement between the US and Iran appear to gain steam as reports of negotiations and the ceasefire holding impacted markets. Looking at the latest outlook from the EIA, as we can see here, the supply disruptions are expected to mostly impact the second quarter of the year, with expectations that by the time we move into the third quarter and certainly the fourth quarter of 2026, we'll see a resumption of exports out of the Middle East. And as a result, by the second half of 2026, we'll once again see a balance to an oversupplied oil market, which is very much weighing on the forward curve for crude oil. Natural gas. Moving towards natural gas prices next, we note the downward movement in gas prices as well. The decrease was most notably felt for the remainder of 2026, with prices for the second half of 2026 down roughly 10% over the past week. The frontier seeing decreases of roughly 6% week over week. Overall, the decrease in natural gas prices in Europe very much directly tied to the improved outlook regarding global LNG supplies, as reports of Iran allowing some transit to the Strait of Hormuz and certainly the ongoing negotiations between the US and Iran, but also between Israel and Lebanon, increasing the optimism that we could be nearing the end of the war in Iran and the end to the supply disruptions that have roiled markets since the start of the war. Looking at the European market in particular, we continue to see that easing total demand as weather conditions improve, reducing gas consumption in the continent, while total supply has remained relatively steady over the last couple of weeks, although it remains at the lowest levels over the past 5 years. Nonetheless, the improved supply and demand balance has kept injections into storage going at roughly the same pace as the past 13-year average, as we can see here. That has helped start to increase storage levels in Europe, with storage levels moving above 30% once again, and keeping the deficit versus the previous year at around 5 to 6%. The European supply mix, however, will face some more difficulties over the coming weeks, in particular given the reduction in Norwegian gas flows as Norwegian gas infrastructure enters its spring maintenance season. LNG sendouts, which have decreased substantially from the highs we saw prior to the start of the war, have stabilized over the last couple of weeks, moving closer in line with the levels we saw in 2025 and the past 5-year average. Nonetheless, if the war continues and the supply disruptions from the Gulf continue, we'll see additional pressure on the US supply outlook. Looking at the planned Norwegian maintenance period, we see that as we move into May, we'll start to see the peak of the spring maintenance period with decreases of Norwegian gas output as much as around 175 million cubic meters per day. Looking at the price competition for LNG between the European Union and Asia, we see Asian consumers continue to pay a higher premium, limiting the amount of LNG currently going towards European consumers. But the decreasing price level across global markets very much indicating the reduced pressure on the market as expectations of an end to the war increase. Investment funds also impacted by the greater optimism regarding an end to the war, as the level of long positions decreased for the first time since the start of the war. Coal. Global coal prices have also decreased over the past week, tracking the evolution that we've seen for global natural gas prices. For the year ahead, we see prices decreasing for the Atlantic Thermal Coal Index by almost 2.5%, with Asian coal prices down by a larger amount by nearly 3.3% over the past week. EU and UK emission allowances. Looking at the price of carbon allowances in Europe, we note an uptick in the price of European allowances of 6.3% for December 26 product. The UK market seeing much sharper weekly increases of nearly 20% over the past week. European carbon prices, which had been weighed down by the prospect of a change to the existing framework and regulations regarding the EU ETS market to improve the competitiveness of European industry, are seeing the latest reporting indicating that any measures may not end up impacting the market in 2026. And as a result, we are seeing a slight increase in the price level as well. For the UK market, the main drivers continue to be the talks of linking the EU and UK carbon markets, adding support to the price level. In terms of power sector emissions, we've seen those increase over the past week. And while part of that is weather driven, another factor to keep in mind is the gas to coal switching that we've been seeing across Europe as gas prices remain elevated compared to the start of the war. Investment fund positions remain relatively stable over the past week as market participants particularly assess what the outlook for any changes to the regulatory framework will be at the European level. Electricity. Moving towards electricity prices saw a downward trend over the past week, especially looking at the last quarter of 2026, given the decreases that we saw in natural gas prices. Now, the uptick in carbon allowances certainly limiting any downward movement, where for the frontier, we see pricing relatively flat over the past week, down just 0.8%. The price evolution across European markets was similar to that of the German power market, with pricing easing off slightly over the past week and settling lower than during the peak prices that we saw a few weeks ago. Looking towards total demand and residual load in Europe, we see that further reduction in total grid demand, again driven by the by the improved weather conditions weighing on total demand, while residual load saw an uptick over the past week, and that was largely driven by a sharp drop in wind power generation, reducing total renewable power output. Moving towards the supply mix, an uptick in nuclear power generation, largely through an increase in French nuclear power output, which is currently performing at the highest levels over the last 3 years, and noticeably above the past 5-year average. As we can see here, renewable power generation saw significant decreases over the past week, moving towards the past 5-year average. In turn, even as total demand has decreased over the past week, it has not been enough to make up for the decrease in renewable output, and as a result, we've seen an increase in fossil power generation, moving from near the lowest levels over the past 5 years to now in line with last year's levels of output. For renewables, we see the decrease driven by a decrease in wind power generation, going to the lowest levels over the past 5 years. At the same time, solar power generation has seen a slight decrease over the past week, but nonetheless is still performing at a record high for this time of year. Hydro generation at the same time remaining relatively steady in line with the past 5-year average. Looking at fossil fuels next, we see that sharp uptick in fossil fuel power generation, especially looking at brown coal and fossil gas output. Hydro reservoir levels remain in a deficit when we look at the Nordics, especially very importantly looking at Norway. Elsewhere in Europe, other than in the Balkans and in the Iberian Peninsula, we're still seeing deficits compared to the average since 2015. Lastly, looking at guarantees of origin pricing has increased along the forward curve, with pricing continuing the rebound that we saw since a couple of weeks ago. Overall, for guarantees of origin, markets are expecting increases in demand for guarantees of origin, especially as we see the growth in data centers and AI-related loads, while at the same time we are seeing tighter supply expectations, particularly as the growth of guarantees of origin supply slowed down through 2025, primarily due to the worst performance of hydro and wind. If we look at the total cumulative renewable generation in AIB countries, we see that while total output is in line with what we saw in 2024. We've not yet seen the type of increases year over year than one was expecting. That's most noticeably felt given the lower hydropower output in line with levels in 2025, but now more notably below the record highs we saw in 2024. The same can be said for wind, and the one bright spot is solar power generation, which is currently at an all-time record high. That covers this week's market presentation. Thank you for joining.